What is going on, investors? Hopefully guys are doing well out there. Time to take a look at those Q3 numbers, which just crossed from Netflix after the bell, and Wall Street is falling in love with this company again, as this stock is up over 14% in the after hours after reporting these Q3 numbers. That is a $34 gain on this stock. We'll get over here and look at this from a technical perspective. We've been talking about this for actually months on our weekly Friday show, where we regularly cover Netflix on that show. And we talked about once you got over 250, there was this big gap, and this stock could fill that gap, not necessarily overnight or after one earnings call, but it's making its way up there from 250 all the way up to 277 in the after hours. We'll talk you through this on the technical segment once we get through there. But I first want to take a pit stop and go through these Q3 numbers in depth. We also got Q4 guidance as well. Now, speaking of Q3, revenue coming in at $7.93 billion. That was a 6% year-over-year growth, and it did beat expectations by about $90 million. Expectations for this quarter was closer to about $7.84 billion worth of revenue. The high-end estimate out of 32 analysts was for $7.94 billion. So this revenue mark for Netflix coming in nearly at the high end of the revenue estimates out of 32 analysts. This company hit it out of the park. Now, before we go into these Q3 numbers in depth, we'll take a look at the shareholder letter, which I encourage you to read if you have time. We'll take a look at the financials, and we'll look at the different geographical regions, and we'll take a look at the cash flows, balance sheet, and the profit and loss statement. But I did want to talk about Q4 guidance. Revenue expected to be about $7.77 billion. Consensus estimate was much closer to $7.98 billion. So they're actually missing the mark a little bit for that upcoming quarter. But given how much they kind of blew it out of the park in this quarter, it could be Netflix is just kind of sandbagging just a little bit, at least on that revenue side. Also, EPS for the upcoming quarter expected to be just 36 cents per share. The consensus was for $1.22. So Netflix clearly going to have a little bit of a backstep when it comes to EPS or earnings for the upcoming quarters. But it appears that Wall Street and investors are giving this stock a pass because, as I repeat, and as we're talking right now, the stock in the after hours, again, up over 14%. Now, some interesting things that they said on their shareholder letter. Lots of talk about the ad-supported program, which should roll out, and that ad-supported tier for Netflix probably is going to be the most popular choice for a lot of people overseas and in other geographical locations. Obviously, it will be popular here in the United States and Canada, and I can imagine the ad rates here in the United States and Canada very popular, but obviously a lower cost option for Netflix probably going to play very well in other countries. But before we get to more of that, I did want to talk about a key point that near the top of the shareholder letter that Netflix brings up is the fact that there are a lot of competitors here, and a lot of the competitors are investing very heavily into driving subscriptions and engagements. You've got Warner Brothers Discovery. You obviously have Disney Plus. You have Hulu. You've got Paramount Plus. You've got a plethora of companies out there creating streaming platforms. But this is the key sentence by Netflix, and I 100% agree with this. They say, but building a large, successful streaming business is hard. We estimate they are all losing money, and that is a fact. When you look at Warner Brothers Discovery's financials, when you look at Disney, even Disney Plus is losing money from an operating perspective to this day. And Bob Iger was on a panel a couple of months ago at a code conference, and he also said that there'll be very, very few streamers that actually turn a profit, and many are likely to shutter or have to consolidate their streaming business, as it just simply costs a lot of money to scale up. So when we walk through these on that backdrop that there's all these competitors and none of them are making money, it reminds me a little bit of Tesla, that you have all these competitors that are certainly very worthy competitors, but none of them are making money yet, and Netflix is churning out a profit. Now, high level overview in the quarter, $7.9 billion worth of revenue in this quarter. That is just underneath where you were a quarter ago, but obviously greater than you were in Q3 of 2021. This company is just steadily growing kind of in that mid-single digits when it comes to that revenue growth, and that's what Wall Street has this company pegged at. We do have an acceleration of revenue growth in the middle to back half of next year. And I believe analysts are starting to factor in that ad tier will bolster up the revenue side of the business, as collecting $8.99, $9.99, $10.99 from customers every month is kind of a slow grind to accelerate your revenues. But all of a sudden you have $1 million ad campaigns or hundreds of millions of dollars worth of ad campaigns from a Starbucks or McDonald's or these big national brands. Well, that'll juice your revenue a little bit faster. And that's what we should anticipate with Netflix going forward. Now let's focus on the subscriber forecast or the guidance that we got. This is incredibly bullish. And I actually think this is probably the number one reason why this stock is up 14% in the after hours, is the fact that the company is expected to accelerate their subscribers over 4.5 million in the upcoming Q4. In this most recent quarter, they guided for, I believe, roughly 1 million new ads. They added $2.41 million. This company is acquiring customers and they are retaining them. And we had 2 negative quarters of subscriber growth in Q1 and Q2, but we've re-accelerated that to 2.4 million subscribers in Q3. And it looks like they're going to add another 4.5 million subscribers in Q4 to bring the total closer to 227 million paid subscribers over at Netflix. That is incredibly impressive. Now, from a geographical perspective, you've got the United States and Canada, obviously the largest market. From a revenue perspective, also their average revenue per membership coming in at $16.37. We'll see how this ARPU changes as they get those ad-supported tiers that are obviously a lot cheaper than the non-ad supported tiers. That'll be certainly something that we can monitor. It's not something that we can predict at the current time, but obviously, with that addition coming very soon, I think part of that had to do with the fact that they're very aggressive in guiding for 4.5 million new subscriptions in the upcoming quarter. The United States and Canada region also stemming 2 negative quarters in terms of those net paid additions to go to, looks like about 100,000 ads in the quarter. Revenue just ticking up very nicely. Again, as that revenue ticks up and that ARPU ticks up, you don't really have to add a bunch of new members, because this time last year, the average revenue per United States and Canada streamer was $14.68, and now it's all the way up to $16.37. Again, a year from now, we'll see how those ad-supported tiers impact that. You have the Europe, Middle East, and Africa. That also stemmed 2 consecutive quarters of net global subtractions on that subscriber side. We added a little over 570,000 subscribers there. Revenue did fall quarter over quarter and year over year there, as you see the average revenue per membership went from $11.65 last year down to $10.81. And I think this is where the addition of that lower priced ad supported tier will help Netflix in the longer run, because it appears they don't have a lot more pricing power, at least at the current time, in this region. Also, for Latin America, solid additions on that net paid additions at about 310,000. Revenue basically flat quarter over quarter. Year over year, you're seeing an increase. And you also saw a year over year increase on that average revenue per membership from $7.86 up to about $8.58. And finally, Asia Pacific, this is where you're seeing the strongest net paid additions, over 1.4 million in that region. But what we are seeing there is the average revenue per user actually going down from $9.60 down to $8.34. So despite nearly 6 million more paid additions to that region over the last year, you notice your revenues went from just $8.34 up to $8.89. Again, this is where that ad tier will definitely come in play in the geographical regions where you can't expand the ARPU like you could potentially do in the United States and Canada. Now, finally, let's get into these financials. We had that 7.9, nearly $8 billion worth of revenue. Quarter over quarter, basically flat. You were basically at this revenue mark last quarter. Last year at this time, you were closer to about $7.5 billion worth of revenue. You flow down to operating income after you pay your cost of those revenues, your marketing, your technology, and your G&A cost. This most recent quarter, you churned out about $1.5 billion worth of operating income. And again, there's no other streamer on the universe, including Disney and Disney Plus, that is churning out an operating profit from its streaming business. That puts this company in rarefied air. And if those other streamers have a difficult time continuing to compete against Netflix, well, not making money on those streaming businesses, eventually those shareholders get a little antsy about that. Now, last year, we actually had higher operating income on lower revenue. So they are impacted by higher cost of revenues, higher technology costs, and higher general administrative costs over at Netflix. You went from $1.755 billion worth of operating income down to about $1.533. That is essentially flat from where you were a quarter ago. So as those revenues continue to tick up, we'd like to see a little bit more money flow down to these operating incomes. But given the backdrop with the competition, you certainly stand out if you're Netflix actually producing an operating profit. On terms of their balance sheet, they've got plenty of cash, plenty of assets. They have some small amount of debt, about $13 billion. I mean, it's not necessarily small, okay? We don't, even after today's big stock price jump that this stock is receiving, you got about 110, $115 billion company. When it's all said and done, you got about $13.9 billion worth of debt. You got about $8 billion in total current assets. Where they sink all of their money and all of their assets are in these content assets. This company has over $32 billion worth of content assets. So you look at the balance sheet and you take the content assets and add it to essentially cash, and you're at about $40 billion. And so that's why when you've got a company, even after today, this is the $102 billion market cap is probably not factoring in a 14% rise if the stock holds those gains tomorrow. Well, we'll just call it $120 billion worth of market cap at Netflix, and you've got $40 billion in either cash or content assets balanced off by liabilities coming in at about $27 billion. This company looks pretty good from a balance sheet perspective. Now, from a cash flow perspective, it paints a glorious story for this company. Had a great cash flow generating quarter as it produced $1.4 billion worth of net income. That's basically where you were at last year. In fact, you were a little bit higher on net income last year, but they amortized their content assets quite a bit more, or a little bit more in the most recent quarter. That helped their cash flows. You come down here to net cash provided by the operating activities at Netflix, coming in at $556 million in the quarter. Last year, just $102 million when the stock was like 60 or 70% higher. You see, for the 9 months, it paints a similar story. They produced $1.6 billion worth of positive cash flow over the last 9 months, or over the last 3 quarters. That's a roughly $500 million run rate per quarter, and that's where they're at in the most recent quarter. They spent about $85 million on purchase of property, plant, and equipment. Last year, it was slightly less than that, and they did issue some common stock by about $4 million. They were a little bit more aggressive this time last year, so slightly less dilution year over year for Netflix. Now, let's come over here and look at this from a technical perspective. If you've been following the show any length of time, we talked about this area over 250 on Netflix, and boom. I mean, we got it. If you took the risk and consolidated and bought into Netflix below this area of resistance, this area is where we gap down. We had 2 different gap downs for Netflix on 2 different earnings calls. So it originally gapped down in Q1, and then it had another bad earnings report and gapped down all the way south of 250. This 250 area also is significant in the fact that it was support for several years, going back to 2018 through roughly 2020. Anytime you got to 250, it touched and then rebound, touched and rebound. Now that you're underneath the 250 level, it acted as resistance. I was waiting for a break above this. Now, there's 2 ways to play this. I wouldn't chase this stock tomorrow. Typically what happens is you have these knee-jerk reactions, and I think there are clearly some things to really like about this company. The fact that they're going to add this 4.5 million net paid additions. This is the highest growth rate since Q4 of 2021, when they added about 8.28 million. So year over year, you're having a little bit less growth, but obviously you're coming in at a little bit higher base when it comes to the total membership that you already have. They have that ad tier coming forward, which I think analysts are starting to factor in. You're going to go from a mid to low single-digit revenue growth at Netflix once those ads start running and they get all these advertisers like Starbucks and McDonald's start running ads. Well, you're going to go to nearly a double-digit grower for really the foreseeable future. I agree with Wall Street's estimates there. How it will impact profitability, I think, remains to be seen. How the users in the different geographical regions maybe shift from a higher price tier down to a lower price tier, and we'll see if those ads can offset users going from $9.99 down to $6.99. We'll see what happens there. Obviously, you have the backdrop of competition as well. We also talked about the fact that revenues coming in at $7.8 billion for the Q4 is below estimates and below expectations of closer to roughly $8 billion. In fact, some analysts coming in at $8.2 billion for the upcoming quarter. So there absolutely is some things to like with this company, and a lot of bad news was already priced in. And when you talk about the valuation and a lot of these things when it comes to Netflix, there are some things to like, but I think Wall Street will digest this. Wall Street is in rally mode, at least over the last couple of days. Most stocks and most sectors are oversold. I wouldn't chase this one. I think we get a pullback, not saying this week, I'm not even saying next week, but over the next several weeks, maybe even the next 2 quarters, you should get a pullback on Netflix near and back to this 250 level. Instead of resistance, which 250 has been since the Q2 earnings report back in April, 250, you have not been able to get your head over Netflix. Now they're going to bust out over it, kind of in a knee-jerk reaction, maybe some short covering as well with this stock. You typically have a back test to this support. You don't necessarily have to get all the way back to 250 if you want to be a little greedy, or start your position if you want like 10 shares of Netflix, start buying a couple of shares before it gets all the way back to 250. Maybe start at 260, 255, 257, somewhere in that area. But you get a pullback back to 250. That, in my opinion, can be a strong buying opportunity. If you are risk averse, you can set a small stop loss, probably close to 235 or even 240 on this one, where you protect yourself to the downside just in case another quarter earnings don't measure up for Netflix. But what we are creating with Netflix in now the intermediate term, going back a couple of quarters, is we're creating higher sets of highs and we're confirming higher sets of lows. This stock is in an uptrend. When a stock is in an uptrend, that is when you want to accumulate on these dips. And on top of that, I think the company made a very nice point that all of its competition is losing money. And if you believe Bob Iger, who clearly has a lot of expertise in this, he is saying that there's probably only going to be a few winners in this space, and I think Netflix is going to be one of them, Disney probably the other, and I think the rest are going to have to figure out some way to make money, or otherwise those competitors are going to have to start shedding costs, shedding content assets, and that's only going to prepare the big guys like Netflix and Disney down the road. That was Netflix Q3 earnings. Hopefully, guys enjoyed today's video. We got Tesla tomorrow. Good luck with your investments.